Interest rates over the next 5 years is going to massively affect assets like the stock market, crypto, gold, house market. Today, I'm going to show you where I expect the prices of interest rates to go over the next 5 years and what these effects are going to have to these risk on assets. If you do enjoy the video, smash the like and subscribe. Let's just clearly look at a monthly chart. Here we're focusing on the US 10-year Treasury note. This is probably one of the best assets to actually interpret and analyze to see where interest rates will continue to go over the next 5 years. Let's just see obviously what's happened over the last 5 years. We've seen basically interest rates hitting zero, and we've seen a slow and steady rise, basically taking that entire 5-year period to come up to a 5% yield, right now sitting at around 4%. And if we do analyze the current price, we scroll in even closer, we're actually seeing a form of a symmetrical triangle forming after a major bullish trend. The probability for this type of technical move is really favors a higher push to the upside. So an expected push to something like 6%, currently at around 4%, so around a 50% move higher wouldn't be unexpected. We also see we've got major supportive factors below. We've got the 50 simple moving average. We've also got the 20 exponential moving average, where we've seen multiple times if price ever close below, we continue in the direction of the slope, as we see the slope is positive, meaning we only look for buys. So right now, price being below that 20 EMA, actually looking quite bullish to look for an entry and for a continuation of the overall trend. But what would that actually mean for interest rates? So if we did see interest rates or the overall stock market, if we did see a push to 6%, what would that mean for the market? Well, that would actually imply that we're going to have a bit of a market crash, because if we were to jump up to 6% interest rates, what would we see? Well, we would see the housing market would go on a decline. Why? Because it's now just harder to get that $200,000 loan, $500,000 loan, $1 million loan. All of those factors, it becomes a lot harder because now you need higher income, higher savings to be able to fund these higher interest rate loans. Also, for something like the stock market and very much risk on assets, even like crypto, it will actually lead to a tumbling down in the overall price. Now, why do I say that? Because it's all linked to supply and demand. And with the stock market and crypto being heavily risk on assets, what you see is a major factor behind having risk on assets for the last 5 years have this major skyrocket to the upside, was because interest rates were so low. When you've got a 0% interest rate, you can borrow money at near zero rates. And if you can get anything more than that 0.5% or 1% on an investment, then you're really out in front. So seeing that 12% gain or 15% gain average from the stock market, we've got an alpha of 10% or more to be able to have there. So if we did see that jump, we'd see a major crash across the market, or what would be expected. Especially a lot of leverage is used in crypto, a lot of leverage is used in stocks, and that leverage then becomes 50% more expensive because it moves from $4 to $6 or 6%. So that would actually see this having a major increase in interest rates, which looks right now is the highest probability play, especially we just continuously making higher low after higher low. And one factor also is, especially with symmetrical triangles, it's most likely to get the explosion in that last third of the triangle. And if we see these two converging lines, the last third of the triangle is right in between this area, and that's where we've just entered. So the point at which we are going to see a huge volatility move is just around the corner. We're either going to see a huge volatility move to the upside or a huge volatility move to the downside, especially because basically since October of 2022, when prices were around that 4% range, we've basically been sideways for this entire time. So this being a monthly chart, we've been sideways for 37 bars or 3 years time. So this really setting up for a major volatility explosion in either direction. But as I just pointed out, the higher probability direction is actually to the upside, getting that continued move to the downside. But to the upside, sorry. But now let's also take into a fact that if we were to see a breakdown, now let's take a look at what would happen. What could happen if we did see a fall in interest rates? I would expect an initial drop below this support line, probably around this $2.50 range. And what would that mean for assets? What would that mean for the stock market? Well, if we do see a major decline in the interest rates from 4% to 2 to 2.5%, it's just going to allow another major move for risk on assets. You're going to see another major explosion in crypto, another major explosion in housing, another major explosion in the stock market. But the reason that I'm going to say that this is less likely of a probability is because we are at all-time highs across the board. We are at all-time highs in the stock market. We're at all-time highs in gold. We're at all-time highs basically in crypto, even though we just had a small decline. We're at all-time highs in housing prices. All prices are at all-time highs. And I don't believe that continuation can last and continue on forever. A small flush out is likely, and even when we just look at the technicals behind the 10-year Treasury bond, the probability currently is slightly favoring a continued upside move. So that's my take of what I'm expecting, where I'm expecting the price of interest rates to go over the next 5 years and what effect it would have on stocks, on housing, on crypto. If you have enjoyed the video, smash the like and subscribe, and I will see you in the next one.